Today on InvestTalk, we talked about the AI data problem, ran down the market today, answered questions on asset allocation and on UPS, and then ended the day talking about how banks are targeting new credit card customers, gamers. Come over to InvestTalk.
This is InvestTalk. Independent thinking, shared success.
Let's talk about AI. And more specifically, the AI data crisis, where tech giants are scrambling for a solution to their data problem. Now, as AI models from tech companies grow in both complexity and capability, they increasingly require vast amounts of high-quality data. However, a new challenge is emerging as websites start to limit the use of their content for training these AI systems. According to a study by the Data Provenance Institute at MIT, there have been a significant increase in data restrictions from web sources over the past year due to both ethical and legal concerns. And this creates what is referred to as, or what has been referred to as this emerging crisis in data consent. Now, this tightening of data availability has led major AI developers like OpenAI, like Google, to scramble for accessible content. OpenAI reportedly is offering between $1 million and $5 million for access to archives from media organizations like The Atlantic and the Associated Press. Other companies that have AI plays, such as Meta, are even considering acquiring publishers, the whole publisher, to secure their AI data sources. Now, some AI companies are even exploring the creation of fake data, synthetic data, as an alternative to using data generated by humans. Now, despite these challenges, some experts believe the data scarcity issue is overstated. One prominent computer scientist from Stanford argued that there are still untapped data resources available in healthcare and education, suggesting that the situation maybe isn't as dire as some predict. It probably isn't as dire as some predict, though interesting nevertheless. Regardless, I see this as an example of one of many impediments to the AI revolution that people haven't discussed. Think about the amount of power that is required to power all of these models. So this is another aspect of it, all the data that is required for these models to learn and grow and process. And so really more than anything, as more and more companies are reporting earnings, showing massive amounts of spending, showing not much to show, with not much to show for it, it begs the question: energy generation, data itself. What is the next issue that these models will face? Let's talk a little bit about the market. It was a decidedly red day across the board. The Dow down 1.25%, S&P 500 large caps down 2.3%, the NASDAQ down 3.6%, even small caps down 2.13% today. And so stocks generally finished near their worst levels. It was the largest S&P decline since December of 2022. The NASDAQ had its worst daily performance since October of 2022. Big tech, a pretty notable drag after earnings disappointments from Google and from Tesla. Other laggards included semis, some payment names, retail, restaurants, travel and leisure. Outperformers, though, again, they're relative outperformers: energy, utilities, medtech. Treasuries are pretty mixed. There was some notable curve steepening on the 210 spread. It's now at its least inverted level since July of 2022. Copper, Dr. Copper, ending down 1.2%, lower for the 8th consecutive session, which is the longest consecutive fall in copper since February of 2020. Crude oil settled up almost 1%, 80 basis points, though off of best levels for the day after yesterday hitting its lowest levels since mid-June. The S&P is now at a 4+% drawdown since its last all-time high on the 16th of July. NASDAQ down 7% since July 10th. The S&P also broke a streak of 356 trading days without a 2% decline. Someone's got to reset the sign somewhere that says X amount of days since the 2% decline, back down to zero. And, it's important to note that the bar has been pretty high, something I've mentioned for earnings going into this earnings period. And commentary, though, surrounding that secular growth tailwind kind of still remains upbeat across the board. Economic growth concerns have been in play amid earnings-related worries about consumer spending, however. Interesting take today from a Fed official, former Fed official that is, Dudley, saying that the FOMC waiting to cut unnecessarily increases Recession risks. Will that weigh on an upcoming meeting on July? I doubt it, but certainly it could weigh on whether or not we start seeing cuts in September. And if the market starts to price in, more than 60 basis points going through the end of the year. July composite flash PMIs were in line. Services looked stronger than expected, but manufacturing moved into contraction for the first time in 6 months. June new home sales well below consensus, softening month over month versus expectations. Core PCE inflation still the highlight of the week, and we will be looking for that on Friday.
Hi, Dave from Ohio. Hey, I was calling in about UPS. I picked some up today at 125. Just get your general thoughts on it, a long-term hold. I love the show, and I'll be listening. Thank you.
So UPS, the United Parcel Service, is a freight shipping, commercial shipping, residential shipping company. And they recently reported earnings on July 23rd with some misses and some pretty bad guidance for the rest of the year, though improving based upon what they said earlier in the year. Earnings per share was at 179. That was 10% lower than expected. Sales revenue was at 21.8. That was 1.7% lower than expected. But again, most people are looking at the forward-looking guidance for UPS. And so within that guidance, the company did see some hopeful signs of recovery within the U.S. shipping market going towards the end of the year and then going into next year as well. So the question becomes, is now a good time to get into UPS? Well, over the past couple months, relative strength has really fallen pretty heavily. It's a $100 billion market cap company. It's got very minimal debt for the business that it runs in, only $26 billion in debt. The interest coverage ratio is 10 times. So debt really isn't weighing on margins as much as it has been for some other companies that are more debt intensive. And so this really continues a slight downtrend that UPS has been facing for a year. But I mean, that makes sense given what's been going on with consumer demand and business demand and some of the logistical issues of freight companies. Now, I think if you're a long-term investor, as I think you should be, opportunities where a company has a fall off like this, a company that's dominant within its industry that is still a pretty well-run business, are buying opportunities. Over the past 5 years, revenue growth up 5% on an annualized basis from year to year, from $71 billion in 2018 to $90 billion last year, supposed to even out to about 92.5 billion this year. And so there is some growth there, and their margins have been kind of recovering from where they were pre-pandemic, hitting a low of 1.6 in 2020, though that makes sense. Now settling out to be 7% this year. So for me, I think that this is a potential for being a long-term winner. I think this is a good opportunity to buy a company at a time when a lot of investors are selling based on earnings, yes, and maybe some forward-looking guidance because they're more short-term to medium, long-term holders. So if you can stomach the interim volatility that probably will be expected for the next 6 months, I think buying at these levels or certainly starting to dollar cost average into this name can be beneficial in the long run. Thanks for the call. We got a lot of ground to cover in the next 45 minutes or so, and here's some of what we have planned today. Try and touch on a topic we didn't get to yesterday on corporate carbon credits. And should we have time at the end of the show, we'll talk about a target consumer, I would say, that credit card companies are going to be going after at some point, and that is Xbox players. Interesting story. Hopefully we have time at the end of the show. We also have some voice bank questions ready to play. One on ADRs versus buying foreign stocks directly, and one on Tellurian Inc., TELL. We also have some questions that came in from the comment section of our InvestTalk YouTube channel. And of course, we welcome your finance and investment questions now or anytime, really anytime you want. Now we're going into a short break. Please remember that you can call anytime and leave your questions on the InvestTalk voice bank. If you're listening via our live stream or on AM 1220 radio in the Silicon Valley area, feel free to call now. Talk to me live. You know the number, 888-99-CHART. Now, I hope you've been telling your friends that our InvestTalk audio podcast is available in video format. Just search InvestTalk with 2 T's on YouTube. And when you leave a comment with a question, we like to get to those because we appreciate it when you go and check out our YouTube channel. And so this question is about APTV. It says, wondering what you guys think about APTV. It looks undervalued and earnings look to be growing nicely. Shares outstanding have increased increase marginally over the last couple years. Wondering if sub 70 is a good entry point to play the electrification trend while still benefiting from use in ICE vehicles as well. Let's take a look at APTV. It's going to take a second to pull up, but APTV is a name that provides supplies and distributes auto parts, primarily associated with car safety. And so it's also a play on automated vehicles as well, on our autonomous vehicles rather, but also has that safety component segment. So it's advanced safety, which is that automated vehicle component, is about 28% of its revenue. It's signal and power solutions, which is just the general safety components of cars, is about 72% of its revenue. Now, in terms of growth, it has some pretty good growth, about 7% over the past 5 years on an annualized basis. Certainly nothing to shake a stick at. On its margins have fallen in half from where it was last year, is what it's projected to be. 14.7% versus 7.7% is what it's projected to be this year. So you've seen some compression on its return on assets, on its return on investments as well. Now it's only got $6.7 billion in debt, even though it's an $18.6 billion market cap company. And cash flow looks to be improving. Cash being the lifeblood of any business. That's one of the things we want to take a look at when we're talking about real growth of a company. Now earnings were kind of outside last year. $10 per share projected to fall down to $6 per share this year. It does not pay a dividend at all. And so with that rotation from technology, you've seen this company fall off over the past couple of days, down 2% this year, or rather 2% today, down 25% year to date. Now, with all of that being said, I am kind of agnostic about this name. I think there's been a lot of craziness over the idea of autonomous driving. And, people who say Tesla robotaxis is the future and companies like this, APTV, which is more of a pure play on the components for it, are the future. I don't see a wholesale shift to that, because then you'd see a lot of short activity within Uber as well, right? That's the whole point of autonomous driving, is you would put out of work the companies that are no longer necessary. And so in a time when maybe the market is focusing on shifting away from those names that have had a run up in the past couple years, past 18 months, which are those AI growth themes, those tech growth names, I don't know if the area where you want to put your money into is an area of the market that is really linked to the performance of CapEx manifesting itself in revenues through those same tech names. So, for me, I think getting involved in the car business at all is risky. Car components for vehicles is certainly a better play, but generally I think that there are better areas where you can invest your capital. Thanks for the comment. Now it looks like we got plenty of time, so let's grab another listener question now.
Hi, Justin and Luke. This is Kevin from Southern California. I have kind of a theoretical question. When holding stock or investing in a foreign company, would you have more protection holding the ADR of a company or buying shares directly on a foreign exchange? In the theoretical event of most extreme event where a country gets invaded by a hostile entity, would either an ADR or having shares directly provide you as a investor any protection or any more protection over the other? Thank you for your thoughts, as always.
Yeah, so an ADR, an American Depository Receipt, and it doesn't necessarily mean that it's held within an American bank, it's just what it's called, is essentially a way for you to get access to an international security without having to buy the local share. But each ADR is backed by local shares, right? It's not that the shares outstanding of the company grow, they're backed by local shares. So if you have a problem politically, right, your political problem being the country getting invaded within a country, no matter what share line you hold for that business, you're going to bear that risk equally. Now, the benefit of holding an ADR is it cuts through the complexity of owning international investments. You also have instantaneous currency exposure, right? You're trading in dollars versus trading in the local currency. But in terms of safety from holding an ADR rather a local line, doesn't make a difference. Thanks for the call. We're headed into a break. My phone lines are open. This is InvestTalk, and I cannot wait to hear from you. Now let's swing back to the InvestTalk voice bank and answer another caller question now.
Hey, Luke and Justin, Bill from Philadelphia here. Question. I own the stock Tellurian, ticker TELL, and it was just announced that they got purchased by Woodside Energy, thinking a $1.2 billion deal. So pre-market today, the stock is up about 65%. Nothing huge, went from 57 cents to like 94 cents around there. With that said, should I be holding on to this stock to see what the exchange is? Is there usually an exchange where this turns into Woodside Energy stock? Just wanted to seek a little advice of whether I should sell on this pop or should I hold it and, I guess, see if they convert into certain stock in Woodside Energy. Looking forward to hearing your answers and love what you guys do. Thank you.
So the company in question, Tellurian, probably mispronouncing that, is a natural gas and integrated oil company. And they recently have fielded an acquisition offer for the whole deal is valued at $1.2 billion. But when you see a merger, you are concerned about the equity piece. In this case, it is $900 million. And so when one company buys another, they can do it in all cash, they can do it in a mixture of cash and stock, or they can do it in all stock. If it's an all stock deal, well, then the price tends to fluctuate, right? Because the price of the acquired company is predicated upon the value of those shares that are being used to acquire it. So it's relative to the acquiring company. So as the acquiring company moves in stock price, so too will the acquired. Now, if it's all cash, like this is, what you'll expect to see if the market thinks that the deal is going to go through is that the value of the company after the deal is announced is the exact or near the value of the purchase offer. In this case, $900 million. So if you look over here, what is the market cap of this company right now? $881 million. Pretty much spot on. And so if you were to hold this, the best that is going to come out of this is you get a couple cents more per share, but it is not going to go above that $900 million, generally. Now, if it's nowhere near the $900 million, maybe that's a signal from the market that the company might not be acquired after all. The deal might not go through, maybe for regulatory reasons. And so in this instance, where you have a near perfect match, if you were to hold on to this, you're essentially holding cash here. So if there's an all cash offer, the stock price pretty much meets the deal terms. The best thing you can do for your portfolio is to just say, this is cash to me, sell it, reinvest it somewhere else.
Hi, Duncan from New York. Thank you for all that you do. Quick question on stock ticker Abercrombie and Fitch, ANF. Seeing that it's actually been for the past year and a half, been going in hyperbolic phase. Just wanted to ask you a couple of things. When I did my quick analysis, very quick, PE ratio is around 20, and I noticed that it's coming off of its high for the past couple of weeks. Just looking for an entry point on this for my portfolio. I'm trying to kind of expand into retail / consumer discretionary. I think that you said in one of the emails. I'm just trying to diversify and looking for a good entry point, or what do you think about the company? Thank you very much and have a good day.
So ANF, Abercrombie and Fitch, it's a clothing company, clothing store rather, not a department store. And they have had quite the year, up 314% over the past 52 weeks, up 74% year to date, 33% over the past month. And that is primarily due to really consistently beating top and bottom lines. They did it in the past quarter as well, and some raised guidance into what they expect is 35% growth this year. And so the question becomes, has it run up too much? Is there room for this thing still to run? Now, their margins have really, really improved over the past 5 years. 2% to 7.7% last year, projected to be 10.8% this year. That means that not only have they raised revenues, but they've also done a good job reducing costs. Their net operating cash flow turned positive in 2024, $653 million, projected to be $700 million this year. They're about an $8 billion market cap company with only $1 billion in debt, so they're not overly levered. They're sitting on nearly $1 billion on cash and short-term investments, and their earnings have been consistently upgraded. Now, with all of that in mind, it is important to note that there's about 8% short interest out there, which means that either the market is, one of two things is going to happen. The market is signaling that this stock price is too high, which it may very well be, or that leaves a lot of room for some squeezes to happen, some gamma squeezes to happen. So taking a look at their relative valuations, it is only trading at 16 times price to earnings, which is pretty modest. It's about at the average of where it's been, though there's some high outliers that shifts that average. So let's take a look at price to cash flow, 11 times. That's pretty expensive. Price to sales at about 2 times for a clothing store. That's kind of expensive too. Price to book at 7.6. Now, post pandemic, a lot of companies don't keep a lot of assets on their book. They have really high turnover and don't hold inventory, so that could push price to book artificially high. But for me, this is still a little too expensive for me. I would probably wait until it comes down closer to maybe a 12 times forward-looking PD. It is a clothing company, maybe closer to about 4 times price to book, keeping in mind that companies don't hold as much inventories as they traditionally have, probably closer to their industry average of a 1.2 price to sales. So it still has some room to run downward, in my opinion, because this is a situation where you have a lot of short interest out there. You have hyperbolic price appreciation going back really 16, 17 months. If this company changes guidance or it doesn't hit or continue to beat its top and bottom lines, you could have a steep drop off here. It's down 4 or 5% today, which is maybe the start of a pullback. But it just doesn't jive with me that if consumers are pulling back, how is this company going to be immune in the short and medium term? It's had a run up. You're probably going to see some consolidation. You may see it drop back to the 120 level. Either way, the risk return just doesn't work out for me at this moment, though I would keep it on my watch list, because certainly the growth is something that you can't look past, but I don't think now's the time. Thanks for the call. Now, we all know that post-pandemic, we really had a once in a generation job market. And although Americans enjoyed that for quite some time, it seems to be that things are shifting back towards normalcy, towards a more typical condition. After a period of red hot hiring and low unemployment, there are now signs that the job market is probably cooling down, not deteriorating as much as cooling down. Unemployment rate has risen to 4.1% for the first time since 2021. And the rate of job openings per unemployed person has decreased to pre-pandemic levels. Now, despite these changes, the labor market is still pretty robust by historical standards, even with the hiring rate having dipped below those pre-pandemic levels and some sectors showing some signs of strains. Interestingly enough, while the market remains strong, there's some uncertainty about whether this cooling trend will continue. Now, this shift is a contrast to the pandemic era's, say, unusual economic conditions, which are unlikely to be sustainable long-term. Someone from Indeed remarked that the extraordinary job market was a result of the abrupt economic halt and rebound during the pandemic, describing it as impressive but temporary. I mean, that makes sense, right? The entire economy shut down and then opened up. As the market adjusts, wage growth has slowed as well. In certain sectors like healthcare, construction, though they continue to add jobs, there are other sectors, restaurants, white-collar jobs, that have really stagnated. And so job seekers in general, it seems, are finding the market increasingly competitive. There's been a significant shift from the ease of finding high-paying jobs just a year ago. And so this recalibration may reflect a probably necessary correction after the pandemic's disruptions, but it also brings challenges for workers and job seekers trying to adjust to this new normal. So why am I mentioning this? Well, I'm mentioning this because it's important to put all of this information into context, into perspective. Just because the job market is weaker than it was 6 months ago doesn't mean it's weak. Just because the economy is slower than it was 6 months ago does not mean that it's slow. It's important to put it in the context from which it's coming. It doesn't mean we're headed for substantial economic contraction just because the job market is slowing. This is, in fact, in reality, we are just returning to a normal level, a sustainable level, a sustainable jobs level for a market with a still growing economy. Now let's hop back over to our YouTube channel and answer another question from the comment section, this one on ticker EL, Estee Lauder. It said, I wanted to ask about Estee Lauder, ticker EL. It did well at the end of 2021, but has continued to fall since then. Cash flow has been in the negative for the last few years. Was wondering if it will ever recover. Estee Lauder is a skincare, makeup, fragrance, beauty care company. Has a lot of brands. Some of them are slipping my mind for some reason. And it really has a strong presence in both brick and mortar and in digital commerce, which is something that is beneficial for this name. But it's been really hammered, absolutely hammered, by slowing growth, particularly in China. But aside from that, the business doesn't look terrible. Yeah, cash flow growth is negative, but cash flow is still very, very positive. Margins have been compressing a little bit, right? From 17% unsustainable in 2021. Their average is closer to about 10%. Now it's projected to be about 5.1% this year. So to me, this is kind of like Ulta Beauty, right? I mean, it's a $35 billion company. It's only got $10 billion in debt. It's not over levered. They bought back a lot of shares in the past 5 years. It seems to me like this is a demand story. This isn't a business that isn't being run particularly well. And so the question, is it ever going to recover? I mean, probably. The pieces are there. Again, the margins are still pretty solid. The 6% margin is pretty solid. The growth, yeah, it peaked out in 2022 and margins peaked out in 2021, but I mean, that's cyclical demand. People tend to cut back on things like the products of Estee Lauder and the products of Ulta Beauty when they are starting to pinch their pocketbooks. So will it ever recover? It might recover. Now, is that a same question as, is this the company I should invest in? Well, it depends on if you can stomach the short-term volatility. In the long run, I think it'll come back. I think it's a prominent brand that has footprints internationally, that has a footprint online and in stores, and that uniquely positions it within the beauty space. But as demand it remains weak, as consumers start to pare back their spending, certainly in the short, maybe even medium term, I don't expect a meaningful recovery. Thanks for the comment. Let's go to Wesley from Southern California, who has a question about Roth IRAs.
Hello, Luke. It's not about Roth IRAs. My question is about asset allocation moving forward. I know we moving into small caps, and I'm wondering in a 401k, what would be the best allocation you would think for the next couple months?
For the next couple months. Well, here's the thing.
Or a year.
That brings up an interesting point here. And so when you think about bucketing your assets, right, you bucket them based on the time horizon. And so your brokerage account is probably going to be the most liquid part because maybe you're using that money to save for a house or you have some impending payment or whatever. Now, your retirement account is your long-term, long horizon. Certainly if you're older, you sound like a young guy, but certainly if you're older, the horizon isn't as short. But for your 401k, I wouldn't generally try and do short-term trading, right? People always complain when the market goes down. Some of my friends complain on days like today when the market's down. And I'm like, you guys, you're in your 30s. You should want the market to be down. This is a time where you want to invest your money. You want the market to be going down when you're accumulating, and you want the market to be at highs when you're withdrawing. So, I would advise generally against within your 401k, which has a longer time horizon, trying to get too cute and make some short-term trades. Now, from an overall investing perspective, this is an election year. Election year means volatility. So, generally speaking, if you're a more risk averse person, I would probably be allocating towards lower volatility sectors. But again, this is your long-term horizon. Don't try and get too cute here. This should be an area where you allocate towards those securities that tend to outperform in the long term. Value-oriented securities, mid caps are a great place to be in as well. Thanks for the call. Now let's play another caller question from our InvestTalk voice bank.
Hi, this is Jake from California. I was just calling to get your guys' take on SM Energy. I do have a position in this, about 3%, and I was just wondering what you guys think about this company for a medium to long-term hold. Looks like the expectations are about an 80% increase in earnings over the next 5 years or so. Would love your guys' take on it. Thank you.
So the question is about SM Energy, ticker SM. Very simple, very straightforward. And it is an oil and gas company. It's a small to mid cap name, $5 billion. It's included in small cap indices most likely, but I would probably say it's probably closer to the mid cap exposure. It's got 10% short interest. That's crazy high. It's got $1.6 billion in debt, and so it's not really that levered at all. Its earnings have recently been upgraded. They've been buying back shares over the past year, down from 122 million in 2023 to about 115 this year. That's certainly something we like. They pay a 1.6% dividend, which is maybe low for a name in this space. Overall, I think what is alarming to me, without knowing much about this name, I don't think I've come across this name. It's one of the smaller oil and gas names I tend to expose to some of those larger names, in the $20 to $40 billion range, because they tend to have manifested some regional monopoly-esque exposure. So I'm not very familiar with this name. So for me, the thing that is most striking isn't that margins have compressed a little bit, cash flow has kind of flatlined a little bit, cash flow growth that is, but 10% short interest is a lot of short interest for an oil and gas name. So, without knowing much about this name, sometimes red flags for me are enough to pass. I would probably go for a more established oil and gas name that has a lot of cash flow coming in, a lot of cash flow growth, and the ability to reinvest and have accretive acquisitions. I just don't think, given its size, the fact that it doesn't have much cash on its balance sheet and that cash flow seems to have trailed off a little bit, that this is one of those names. Thanks for the call. Speaking of oil and gas names, the United Nations has expressed strong opposition to companies using carbon credits to neutralize their carbon dioxide emissions, a stance that conflicts with the practice of major oil and tech companies. Tesla, for example, I think half of their profits in this quarter came from selling carbon credits. Now, according to a draft document prepared by a UN task force and reported by the Financial Times, the UN is urging companies to focus on reducing their emissions directly rather than relying on the carbon trading market, which is worth millions. Major companies like Chevron, Exxon, Microsoft, Apple currently incorporate carbon offsetting in their climate strategies to meet commitments made to investors. This practice is also common in industries with high carbon footprints such as steel, cement manufacturing. And these credits are supposed to support projects that reduce or capture CO2, like forest conservation, CO2 storage, etc. Now, the carbon credit market itself, it's an interesting market. It's expected to expand significantly, estimates suggesting it could grow to between 10 and 40 billion annually by 2030. Even though the market experienced a decline last year, with the value of used carbon credits dropping to just under $1 billion. But the UN Secretary General has emphasized the need for entities to focus on actual emission reductions to avoid questionable carbon credits. The draft UN document, it's only a draft, asserts that carbon credits purchased outside government-regulated schemes shouldn't really count as direct emission reductions by purchasing companies. This document is part of the UN's broader efforts to regulate and scrutinize the global carbon credit market, with input from major UN agencies still to come. Given the prevalence of carbon credits within many industries globally, should the government stance on them change, you would likely see higher costs, you would likely see reduced profits, you would likely see increased exposure to certain risks, and more often than not, a change in the calculus for what many companies are worth, and maybe a recalibration of how we see the value of energy companies themselves. Now, this is InvestTalk. I'm Luke Guerrero, and we have one goal here, and that is to help you achieve your financial freedom. Our work continues after this break, so get your questions in now at 888-99-CHART.
Just had a quick question for you. Wondering if we should be investing in other exchanges and how exactly we would go about doing that. So obviously I'm invested in a bunch of international companies or international stocks through the New York Stock Exchange or the exchanges we have available here in the U.S. For diversification purposes, are there others outside of the U.S., other exchanges that we should be looking at trading stocks on? Appreciate any information or any thoughts you may have on it. Thanks. Bye.
Yeah, well, we talked about one of the ways that you can invest in other markets earlier through ADRs on U.S. exchanges. I think that's the easiest way to do it. It kind of helps with that currency exposure as well because it's instantaneously priced in to the value of the ADR. You can invest in international ETFs. I think when you're talking about emerging markets, the best thing to do is to invest in ETFs that trade within the U.S. That invest in those emerging markets because there's a layer of complexity there, right? Certain markets have requirements around foreign ownership limits that the ETF companies are going to take into consideration. They have requirements around the complexity of regulations surrounding addresses for custodying these accounts. There's a lot of complexity there. And so I think for retail investors, generally, the best way to invest in international markets is looking at certain funds or ADRs through U.S. exchanges, just because it eliminates the layer of complexity. And certainly given the outsized returns of U.S. stocks, U.S. equities over the past couple years, there's a lot of value out there internationally. So I applaud that you're looking beyond the United States and keep doing what you're doing. Thanks for the call. Before we head off for the day, I wanted to talk about something interesting, and that is that banks are targeting millennials and Gen Z through the booming $57 billion a year video game industry. Barclays and JP Morgan Chase are leading this trend by integrating financial services with gaming, offering specialized credit cards and in-game purchase platforms. Now, Barclays has partners with Microsoft to launch an Xbox MasterCard, encouraging spending by offering gamer-focused rewards. The average gamer, often engaged in platforms like Xbox, PlayStation, and mobile games, presents a new demographic for credit card companies looking to expand their user base with rewards that resonate with their lifestyle and spending habits. Barclays, known for its partnership with airlines to offer rewards cards, is applying a similar strategy to the gaming sector, hoping to tap into a younger, tech-savvy audience. Now, the initiative reflects a pivot, I think, from banks who are looking to tap into a generation that may be hesitant to get involved in credit cards, attract new clients, and still manage the risks associated with the fact that what they're trying to target is people who may not have as established incomes, younger consumers, really. But that's the benefit of where credit card companies make their business, right? They make their money from rolling interest. And so this segment seems to me at a time where, according to recent bank earnings, interest income hasn't grown as substantially as it has in the past, with consumers paring back, could be an interesting new avenue for banks. And so as financial institutions continue to innovate, they are probably going to continue to search for areas where they can merge lifestyle perks with these financial products. And so the success of this is definitely going to be a harbinger to come for where banks are going to be able to create new customer bases in new areas of the market. Now, unfortunately, it seems like we do not have enough time to answer another caller question. But as I said, I'll be back here at InvestTalk every day this week. Justin decided he wanted to take some time off, and you know what? He deserved it. So I look forward to hearing more from you. More live calls, more voicemails, more questions on the InvestTalk YouTube channel. And you know, if you're interested, this week we should have a really interesting newsletter for you guys. We're going to talk about the rotation into small caps and out of some of those large cap names? And is it really a rotation at all? I'll give you a hint. Take a look at SPY, take a look at RSP. I want to know your thoughts on it before I tell you mine. Now, I'm Luke Guerrero, and this completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads. You can get yours anytime at iTunes, Google Play, and Spotify. Be sure to rate and review us on iTunes. We really would appreciate that. Also, come over to YouTube. Check out our InvestTalk YouTube, search InvestTalk with 2 T's, or our Instagram, that's also InvestTalk with 2 T's. Independent thinking, shared success. This is InvestTalk. Good night.
Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.